Volatility is a movement, risk is when you lose your capital fully. If you are recovering, it might take some time, plus or minus, but volatility can be on your side also. So at such times, I would say that you should play volatility in your favor. Whenever the market corrects more and your normal SIP is going on, put extra. Invest money then. Typically, your emergency could be job-related or health-related. People do take health insurance for health, but still as a contingency. In my opinion, correct asset allocation is more important than the right product. Because if you look at the long term, you don't see much of a difference. Yes, if you have chosen a very bad fund, then it's a different matter. One whose condition has completely deteriorated. Otherwise, broadly, if your asset allocation is correct, then you will be having a good return or a sustainable good return with your risk appetite.
India is witnessing one of the biggest financial transformations in its history. From a country that traditionally relied on fixed deposits and physical assets, it is now becoming a nation that is steadily embracing mutual funds, equities, and long-term investing. Every year, millions of new investors enter the market, and the role of disciplined asset management has never been this important. Welcome to Market Pillars Uncovered, an educational series where we simplify investing and bring you insights from the leaders who are shaping India's financial ecosystem. Joining us today is Mr. Seemant Shukla, CEO of Quantum Mutual Fund and a seasoned BFSI leader with over 2 decades of experience in banking, asset and wealth management, insurance, and financial distribution. Quantum has been a pioneer in many practices in the industry. From advocating transparency to the 12-20-80 asset allocation model, introducing frameworks that help investors build stable and resilient portfolios. In this episode, we will explore the evolution of India's mutual fund industry, the importance of risk-adjusted returns, disciplined asset allocation, investor behavior, and how thoughtful investing can create predictable outcomes in the long run. Seemant, welcome to Money TV.
Thank you very much for calling me on this show.
So, Quantum Mutual Fund has positioned itself as a thoughtful, investor-first AMC. You also have a strong emphasis on value investing. So, first things first, if you could tell our viewers exactly what your investing philosophy is and how you have shaped it up.
So, Quantum started in 2006, and I think it has been known as one of the first very investor-focused and very investor-friendly AMCs. So the core thought process is that the investor is at the center of everything we do. Transparency is the core thing, that whatever we do it with transparency with all stakeholders, including the main investor. Along with this, if you see, our investment philosophy has a very core focus on ethics and governance. In our framework, governance is a very important parameter, and it's not just for one scheme, it's across all schemes and everything we do. So if you ask me, along with investor focus, all investments are based on a core framework of transparency, ethics, and governance. So much so that Subbu and Ajit has been the founder. In the late 90s, they started something called an integrity screen. That integrity screen with 4 parameters was created for governance checks, and today Chirag, who is our CIO, can run that integrity screen with 200 parameters. So our first filter for the investment thesis, investment policy, and stock selection starts with governance, with the integrity screen as the main core. And I think that's a very, very unique thing. It has only evolved and gotten better over the last 20 years. We were one of the first few funds to launch an ESG fund as well, and we also have an ethical fund. So these funds weren't launched just because it's a fashion or a trend, but primarily drawn from the principles of governance, that since there was governance, you can see it there. In an ethical fund too, governance and environment are related. Similar things will be in an ethical fund. ESG is also the same. So India's first launch in FOESG was ours, although I think 1 or 2 others converted their funds. So that's the core. The client is at the center and everything else surrounds that.
If we talk about today's market, there's a lot of focus on short-term rankings. There are many products in the market and more keep getting launched. So in such a scenario, how is Quantum maintaining a long-term disciplined approach?
You've asked a very right question. First, I'll say that in 20 years, we have only 14 funds to date. So that shows that what we know well and what is good for the investor from our point of view, we will only do that. So we aren't in that race or that crowd where we have to launch new NFOs every day. For a long time, we actually had only one fund. Then the second one came and very unique funds followed. Coming to short-term versus long-term, we all know there's a recency bias. An investor looks at one-year performance, because of which old numbers look different and investment happens. I think our thought and our effort have been to tell the investor what the right thing is regarding those matters. That's why we have things like an asset allocation framework of 12-20-80, which I'll explain to you in detail. We call it our 12-20-80 asset allocation framework. In our communications as well, we emphasize that if we suggest another scheme to you, or if our partner distributors do, we ensure that the overlap ratio is as low as possible. The effort is that if you have taken this product of ours, and if you take another product, the overlap ratio is low, so you are not buying the same stuff under two schemes. First of all, there are very few schemes, and out of the 14 schemes to our ETFs, one is a gold ETF, one of the first few funds, and one is a Nifty ETF, and it has two wrap products. So if we remove these two products that stay with the wrap, then we have only 10 products. So that way, we have been consistently focusing on what is right for the investor. Apart from this, there have been some other investor-related things that Quantum was perhaps one of the first few to start. Like the Total Return Index, which came into regulation in 2018. We are following since 2006. We never charge entry load as a practice since 2006. If you remember, exit load used to appear in the AMC's books at one time, and then regulation came that you should adjust it in the NAV. We have been practicing this thing since the launch time in 2006. We have done all the customer-related things right, the overlap ratio has been low, and our effort in communication and all engagements is to see what is right for the client and look a bit long-term. Usually, it happens that in a shorter period, when the market is very fast, only then money comes in, and that may not be the best time for investment. So our effort is to tell the client the right thing at the right time. Like last year, our effort was that for our equity investors who were new, it's about August 2024. From that time until a bit later, we always asked our clients to go into liquid or any non-equity asset product or maybe multi-asset. So our effort has always been to tell them. But it's tough. It's a behavioral bias. It will take time. We learn something from cycles. One understands when one sees the market cycle. There are long-term investors. Sometimes they forget. Then that better investor makes money. So that's our thought.
This 12-20-80, can you get into more detail exactly what it is, because it's quite interesting and quite popular. Whenever Quantum Mutual Fund is talked about, this one number and one term comes forward.
So globally there is a thumb rule model. In investment, many things are thumb rules, although in personal finance, personal is important. So in the thumb rule model, globally 60-40 is the ratio that you put 60% in equity and 40% in debt, so it remains proportionate. But I think there was also a tweet from the CIO of some big financial institution. 60-40 is out, 60-20-20 is in. So 60 equity, 20 gold, 20 because last year precious metal has done well. But Quantum has been promoting for quite some time from 2022-23 onwards. Propagating this thing that if you do 12-20-80, then you would want a decent return, and in the long term, actually, if your compounding is with a decent return, then you can accumulate a decent amount of wealth. So what is 12? What is 20? What is 80? I will tell you. Because in India, social security is not there yet. if we leave aside government departments and some companies, there is no pension per se. No doubt there are some government initiatives that are being made for certain levels of segregated segments. But even now, if you look at it, unlike the developed world, we don't have a social security network. Now, in that context, you might have some emergency situations. And we've seen during COVID times that people faced difficulties because jobs and everything else suddenly stopped. So, there's an emergency fund that we refer to as 12. So, if your monthly expense is X, then you should keep 12x of that in a liquid fund. So, primarily, you're also taking a debt option in a way. But you're getting liquidity. There's a 7-day exit load, after which your money is free, and broadly, you're making a decent amount of money. So that's 12. 12 months of expenses. Well, it depends on whether you're an aggressive investor or if you already have capital, then you can have 6 months or 24 months. Also, so you can even keep 6 months worth. If you feel like, no, I can manage my money and I have enough capital, then instead of 12, 12 is more of a rule of thumb, otherwise, you can even keep 24. If you feel like, no, my job situation is different. So, an emergency fund, typically, your emergency could be job-related or health-related. For health, people do take health insurance, but still, as a contingency. The second thing is all other expenses. If you look at your lifestyle, children's education, children's marriage, buying a house, these are more planned, like when the child will go to study, which college they'll go to, you know all those things. The remaining money, you can keep 20 rupees in gold and 80 rupees in equity. Depending on your risk appetite, you can invest in various equity assets. In all sub-assets. If you do this, then broadly, you create a very good portfolio. From a long-term perspective, I won't say short-term because right now, the impact of 20% gold will seem a bit much. But broadly, if you look at the long-term, you'll have it because gold and equity are usually lowly correlated or oppositely correlated. People say that debt also stays opposite to equity, that if interest rates rise, equity returns will decrease and vice versa. But I have my own experience because I've also been on the wealth management side. In India, there have been a few times when both have risen and both have fallen together. So there has been that type of net off. So we feel that gold, and typically, when do you buy gold? When there's more turbulence in the market, more volatility or uncertainty, at that time, gold is usually seen as a safe haven. And at that time, it gives you that type of stability, and obviously, in the form of debt, you have your liquid fund which gives returns of 6, 5.5, 6, 7, whatever it's making. So this is 12 liquid, 20 gold, 80 equity.
Nice, interesting. But another thing that commonly comes up about quantum AMC is that you don't just chase absolute returns, but you also give a lot of weightage to the predictability of outcomes and risk-adjusted returns. So, practically speaking, if you could explain this philosophy or approach for an investor.
So, typically, you might have heard. Sometimes it feels like, when I speak, it shouldn't sound like a cliché. The 4 Ps of people, philosophy, process, and the fourth is performance. We try to use that performance to see if we can create a portfolio. If you take any stock today, as a fund manager, you think that it will reach a certain level. Within a time frame, it will reach a level. And that's what we harp upon process really very high because we've been doing this for 20 years and in between, a couple of fund managers have changed. Our CIO, of course, has been with us for a long time. But if you see, we harp on the process so much that despite changes, whereas usually when a fund manager changes, there's some change. In our case, if we see, we've harped on this process so much that we broadly derive a range of predictable outcomes. And it's a very simple principle, nothing too complex. As I told you, our governance is the first filtration. Second is our liquidity, because in the stock market, when the market is bad, liquidity dries up very quickly and you don't know the impact cost at that time. So, second is our liquidity, especially if I talk about the value fund. Third is the fair value of our stock that we've predicted, say, after 2 years with various research and all those things. If it's 100 rupees, I'll take it at 75 or below. So, that 25 rupees is my margin of safety. It'll be 100 rupees in 2 years. If I take it at 75 today, from 75, when it goes to 100, you get approximately 25, 30, 33% return in absolute terms. And if you calculate the CAGR, it's 12 to 14%. We feel that if in the long term, say, the Sensex is 13%, if we can do better than that, but through this process. So, the effort is to price it correctly. Two important aspects here are whether your fair valuation is correct, your research. That's quite strong for us. As an AMC, we have a sizable number of research team in-house. So, it's not just market-driven or market infrastructure-related or broker-led, we do our own research. So, that's a very important thing because ultimately, the fair price you're estimating is very important because if that's wrong, your entire calculation, the math, will go haywire. So, that's one thing, and this defined process of ours, that fair valuation is 100 and we buy at 75 or below. Because of this, if you look at our 20-year data of the value fund, many times opportunities aren't available. The thing is worth 100 rupees, but maybe it's available at 80 or 90, so you're not getting that much upside potential. And we usually keep a 2-year track record on a rolling basis. Now, sometimes what happens is if it's 80, you'll see that we take the cash opportunity. And because of this, if you look at our fund, during some bad periods when valuations were high, we've been, as a residual, our cash appears higher. So, this is one process we are harping on. It's been 20 years. The effort is to impact people, philosophy, and process so much that we can at least derive a range of predictable outcomes that yes, this much will be made. It's never 100% anywhere, but we've had a decent track record so far regarding that.
But the latter part of it, which is risk-adjusted returns, if we have to focus on that, how should retail investors evaluate performance?
Look, there are two things. If you look at it that way, and I will also talk about my fund or explain it in that context, primarily you look at standard deviation volatility in isolation, which is how much plus or minus you are going from your own returns. In 15%, if someone says its standard deviation is 3, then 3 this way and 3 that way. So, in one standard deviation, you can roughly assume that 15 could become 12 or 18. The narrower this band is, the fewer ups and downs you will see. I will give a simple example. If you want to go from here, let's say, from here to Bandra, you have to travel, let's say, 5 to 7 kilometers. One driver is taking you at a constant speed and the other one is also taking you. But sometimes he goes at a speed of 80, sometimes he hits the brakes, sometimes he goes at 20. So, with the one driving at a constant speed, the passenger will probably be a bit more comfortable, relaxed mentally. In the other one, there will be jerks. The person will say, "How are you driving?" So, this is the impact of volatility. You will reach the right destination, but how many ups and downs were there? So, this becomes one risk parameter. The second one is what your market-related beta is. So, my suggestion for risk-adjusted would be to look at the Sharpe ratio, typically. Basically, how much return you are making per unit of risk. Second, I think in a very recency bias, it happens that when a fund does well, you are only looking at one leg of it. When it is growing well, it grew more. But another important thing is, when the market falls, how much does it fall? This can be said in a very simple way. Upside versus downside, this is an important thing. If your upside versus downside ratio is above 1, then your fund is doing okay. If it is 1, then it is equal to the index. If the market rose 10 and the fund rose 15, and the market fell 10 and the fund fell 15, then basically the ratio 15 by 15 is 1, 10 by 10 is 1. So basically, you will only get the index return. For that, then, that is not the right thing. So, up market capture versus down market capture is one thing. The lower the standard deviation, the lower your volatility will be in isolation, and you can look at beta a bit. So this is it. And the Sharpe ratio, as they say, is a way to see how much return you are generating per unit of risk. That is for 1 unit. So these 3 things should be looked at. We try quite a lot. Usually, one of our because I said liquidity is important, so in our value fund that you were talking about, we usually have only large cap or mega mid cap. So their volatility is better than mid and small cap. And we also try ourselves. Third, because we keep a margin of safety of 25%. While getting into that. So that gives us a cushion that if it has already fallen 75, then how much more will it fall? So that is one way we also manage that risk.
Interesting. But with the way the market is going through excessive volatility right now, in such a situation, should asset allocation be something that is more important, or stock selection, or market timing? Of course, nobody can do it, and nobody should do it. But what is more important according to you?
Look, in the short term, the impact of market timing is visible. If you enter at 25,000 rupees and then at 20,000, you'll see a difference. But in the long term, it averages out because everything comes to a mean reversal. As for the first part of your question about asset allocation versus stock selection, the first thing I'd say is that unless you have a full understanding of equity, no, don't do stock selection in this market at all. Because you never know, as they say, the knife is falling, you don't know how low it will go. You buy at 50% and then it drops to 25, then recovery time is longer. Second thing, when 100 rupees becomes 50 rupees, to get back to 100 from 50, when it's down 50%, you need 100% gain. So this calculation is very important in investment philosophy. Thirdly, I think it's better to choose a good fund manager and enter via SIP mode in this type of market. Because in this type of market, volatility is not just risk, it's a common conundrum that volatility is risk. Volatility is movement, risk is when you lose your capital entirely. If it's recovering, it might fluctuate within a time frame, but volatility can also be on your side. So at such times, I would say play volatility in your favor. Whenever the market corrects more, while your normal SIP is running, invest extra money then. That will give a good return in the long term. Asset allocation, yes, is very important. And I think the importance of asset allocation is understood in this market. When the market is booming, everyone sees the upside of the returns and everything. But when the market does these kinds of flip-flops, you actually understand that no, other asset classes that are lowly correlated or inversely correlated, they are providing a much better cushion against this volatility. So, in my opinion, asset allocation should be the core for any investor, which may change depending on their risk profile, behavioral risk appetite, and everything, but it should be the core. Until you have a full understanding, you shouldn't do stock selection in this type of market at all. You can actually have a real risk of losing capital as well.
But from a retail standpoint, what is more difficult? Choosing the right product or staying invested in the market in a disciplined way for the long term?
In my opinion, correct asset allocation is more important than the right product. Because if you look at the long term, there isn't much difference. It's a different matter if you've chosen a very bad fund which has completely deteriorated. Otherwise, broadly speaking, if your asset allocation is right, you will have a good return or a sustainable good return commensurate with your risk appetite. That's one part. Secondly, as you said, I think one should be a long-term investor. Because with mutual funds or any asset management platform, it's basically like whether you drive the car yourself or give it to a driver. The driver is much more mature and has experience. I think that's the vehicle's pathway. Invest for the long term in this, but do review it. I think this is an important aspect, that it shouldn't be that you've taken some dud scheme that's not performing at all and after 10 years you feel, no man, this is an opportunity lost. So as they say, I always say that investment is like that child of yours whom you've put in a hostel. Call them once a year to understand, to review. That's my thought.
Interesting. If we look at the investing landscape of India, from being a nation of savers, India is now transitioning towards being a nation of investors. So in the next 5 to 6 years, how do you see the investing landscape evolving, and especially the mutual fund industry if we focus on that?
So I look at it in a different way. I would say that a nation of savers went into being a nation of traders and is now becoming savers, investors. But that's more of because if we see, until 2019 there were about 3 to 3.25 crore demat accounts in the country. Today it's almost 20 crore. Trading has gone up, which has also given some red flags from a regulator side, F&O and all those things. Similarly, gaming and other things have got a much higher number. But yes, mutual funds are also growing. But I feel that as a country, our per capita is hovering around, let's say, 2,700 to 3,000 or so. And when your per capita goes up, typically if you see developed markets as well as emerging markets which are slightly higher on per capita, the capital formation or capital market investment usually happens. It starts significantly around 4,000 to 5,000. And there's a basic reason for it. The reason is that when you are around $500 to $1,000, you primarily focus on basic necessities. If you look at the 90s era until the time we were kids, most people's expenses went only towards dal, rice, roti, and shelter. The next level of growth, if you see, is beyond basics, which was between $1,000 to $2,000. During that time, your two-wheelers, phones, TV, and you can see India's lot of automobile companies were there, how much growth they have given, how much wealth they have created. The third comes, which is now, is the 2,200 to 3,500 type where aspirational, basic is done, beyond basic is done, then aspirational. And today you can see that things which are basic are not in demand, rather things which are slightly aspirational are in demand. Experiential economy, high-end cars, mid-level, all those things are taking shape. Next is that when everything is done, then a person thinks about the future. That boss, with this lifestyle I will also get old, then how will I maintain this? And then capital market investment happens. So I think we also need to look at that, which we have seen a good amount of jump in the way the industry has grown, be it. I would even say, if you've noticed, a great thing which happened was a Jan Dhan, Jam Trinity. Those who were unbanked, there used to be around 32 to 33 crore banking accounts. Today there are 85 to 90 crore. Those who were into FDs and other things have moved into SIPs and mutual funds. Those who are slightly sophisticated got early entry into mutual funds, getting into other alternate level platforms like PMS, AIF, SIP. So this is a trajectory which is tectonic shift. Everything is moving in that direction. So I feel as a country we will be doing much more capital formation by investing in, and there are good things which are happening. It's not only equity as a capital. Now you are having REITs, in which you are getting bond market is coming, regulator RBI has come with RBI retail buying of bonds, although it's yet to take off, but multiple, if you see vectors, then all are growing. Some have more speed, some have less, but as a country, yes, and we are now large economy. If 25%, 30% of 1 trillion used to be 300 billion, then today at 4 trillion it would be a pretty large, almost equivalent to what our economy was in 2006-07. That way it's going to be a really great place.
Interesting. And you have seen this entire journey and evolution, whether it's of the economy or the markets. You have seen many cycles, you have worked in many segments of BFSI, banking, insurance, asset management, which is that one leadership lesson that has really defined your career or your journey.
Perseverance and passion. 2P. I am a graduate from a science side, and that two very different stream. I am a fishery graduate. So and obviously with today's generation it might be slightly different because they know what they don't want to do. I think 90s and 80s kids, they made their career just like a flowing water in river. that it just kept forming as it flowed. But two things which I personally felt during when I look back at my journey is perseverance and passion. Whatever I have done with lot of passion, that's my business I have to build up.
And the industry you are in is quite fast-paced, so anything you do to unwind to stay grounded and motivated?
So one thing is market makes you humble. That's the beauty of this particular business, at least, that you should not have any qualms around that. Secondly, I feel that things are changing fast. The pace of speed was very different till 2010. 10 to 20 was different, and 20 to so. I think lot of unlearning what is happening across, and especially on tech and digital side, how people interact with you has changed. How people transact with system has changed. And it's evolving. Every day something new is coming, new platform is coming, some learning is changed. Earlier, I remember in earlier times we used to do client event distributor when I was in wealth, also distributor, event, physical meeting and all those things. Now things have moved to webinar, Twitter snippet. So another thing is big thing is articulation in a shortest form, because it's attention economy which is very small with a new generation, so you have to capture that time period and hook. So these are few things where unlearning and learning is important.
Wonderful, and for sharing both your learnings and unlearnings and your journey with us today. Thank you so much. It was a pleasure having you on Money TV.
Thank you for having me on the show.
That's all for this episode of Market Pillars Uncovered. If you found this conversation insightful, then like, share, and subscribe to Money TV today. Because here we don't just talk about markets, we decode philosophies here, uncover financial strategies, and introduce you to the minds that are shaping India's financial future. Until next time, invest smart and stay informed.